Good morning and welcome to the AASB webinar covering the proposals on ED 297, proposing to remove the ability for certain for-profit private sector entities to prepare special purpose financial statements. We thank you for taking the time to join us, especially given it must be a busy time of year for many of you. Let me introduce your presenters today. My name's Kim Carney and I'm one of the project managers here at the AASB, and today I'm joined by Carla, our technical director. Before we start, just a few housekeeping matters. I hope all of you can hear us as well as see the slides. Now you should be able to see a control panel on the right hand side of your screen, and this is where you can communicate with us if you have any questions as we move throughout the course of today's webinar. You should also be able to see and access two handouts, the first being a key facts paper summarising the proposals, and secondly a PDF of the actual exposure draft. Both of these documents are also available on the AASB website, but have been provided as part of the webinar for ease of reference. So now let's see the agenda for today. During the next hour, we're going to provide you with information regarding the proposals, including why change is needed, who will be impacted, and what is being proposed. We will also outline the proposed transitional relief, along with the proposed timeline for implementation. We would like this session to be as interactive as possible, even though it is a webinar, and while we have a Q&A section towards the end of the webinar, if you have any questions as we move through the content, please raise them as mentioned via the Ask Question function. We will try and answer as many of the questions as possible as we move through the content, but with such a big audience today, it may not be possible to get to all of them. So if there's any questions that aren't answered, we'll certainly come back to you offline. Now, before we get into the detail of the material, we wanted to understand a little bit better the composition of today's audience. So we're going to work through our first poll question. You should now be able to see that on your screen. If you could please select the option that is most relevant to your role. I can see that a majority of the audience today have voted. We'll just wait a couple more seconds. Okay, I'll now close the poll. So as you can see, we've got a slightly diverse audience, mostly preparers with some auditors and some technical advisors also. So it's good to see we've got a spread of audience on what is a very important topic. Okay, so as mentioned, the objective of today's session is to provide you with an overview of the proposals and a recap on what has occurred prior to ED 297. And as I mentioned, we're very keen to hear from you, so we encourage any and all feedback, and we'll provide you with the many ways that you can engage with the staff at the AASB towards the end of today's session. So what exactly does ED 297 propose? ED 297 proposes removing the ability for certain for-profit private sector entities to prepare special purpose financial statements. Now that's certainly a bold statement, and we'll go through the scoping of the proposals in more detail shortly, along with some statistics about exactly how many entities we think will be impacted. But essentially, ED 297 proposes that all entities that are within the scope of the proposals will be required to prepare some form of general purpose financial statements. As part of the proposals and to make general purpose financial reporting less burdensome, the AASB has recently issued a separate but related exposure draft, ED 295, which proposes a new simplified disclosure framework in place of the existing Tier 2 reduced disclosure regime. There's a separate webinar this afternoon on ED 295, which you're welcome to join, and you can still register for that via our website if you haven't already done so. Now, in order to facilitate a proposed effective date of annual reporting periods beginning on or after 1 July 2020, ED 297 also proposes some transitional relief in addition to that which is currently available in AASB 1 and AASB 108, and Carla will take you through some more of the relief in more detail shortly. So, why do we need to make the changes? Australia is the only country where entities can self-assess what type of financial report they do, that is, general purpose financial statements or special purpose financial statements, and this causes various issues given that the assessment of reporting requirements is performed by the entity itself, is extremely judgmental, and often leads to two similar entities preparing very different sets of financial statements. The outcome is what we refer to as the special purpose problem. And special purpose financial statements are exactly that, financial statements prepared for a special purpose, so therefore preparers can choose which accounting standards and accounting policies to apply based on what they think will best meet the needs of their users. Now, this optionality has led to inconsistent recognition and measurement practices, making the comparability of financial statements difficult, and also leading to significantly reduced disclosures, and that's something that's not necessarily in keeping with ASIC RG 85, which Carla will talk about shortly. Now, the issues with special purpose financial statements are not new, and for more than a decade, the board has been undertaking work to try and address the problems that arise from entities being allowed to self-assess whether they prepare special purpose or general purpose financial statements when they are required to comply with Australian accounting standards. The board's initiated many research projects, undertaken significant outreach, and has also issued documents for public consultation, including most recently ITC 39, the predecessor of ED 297. The findings from empirical research and feedback from stakeholders highlights that special purpose financial statements certainly lack consistency, comparability, transparency, and enforceability. And we've heard from users that comparability, transparency, comprehensibility, and consistency are what's most important to them. We also know from ASIC that the financial statements of large proprietary companies, small foreign controlled proprietary companies, and for-profit unlisted public companies limited by guarantee are accessed more than 98,000 times per annum, certainly suggesting that there are users. Research also suggests that the reporting entity concept is neither well understood nor is it always applied as intended, and this leads to entities inappropriately lodging special purpose financial statements on the public record, and ASIC and other regulators have also advised that the reporting concept is not enforceable as it is too judgmental. Another reason we need to make change is due to the revised conceptual framework issued by the AASB in March of 2018. Now, the revised conceptual framework describes the objectives and concepts for general purpose financial reporting under IFRS standards, and it assists anyone looking to understand and interpret the standards. That said, the revised conceptual framework's concept of the reporting entity is different from that which is in SAC 1 and some accounting standards, and that inconsistency must be resolved, and that's also part of what we're trying to achieve. So who is affected? The proposals in this ED apply to entities required by legislation or by their constituting document to prepare financial statements in accordance with Australian accounting standards, or in some instances accounting standards, and there are some exceptions to this which we will talk through in more detail shortly. These proposals do not apply to not-for-profit entities, and they do not apply to public sector entities, as the reporting frameworks for those sectors will be addressed via separate consultations containing targeted proposals at a future time. Now I'll hand over to Carla, who'll take you through the next part of today's session.
Hello everyone. I'll now talk to you about the requirements in ASIC's Regulatory Guide RG 85. As you know, this guide has been in place for some time, and it requires that all non-reporting entities which are required to prepare financial reports in accordance with the Corporations Act should comply with the recognition and measurement requirements of accounting standards. It also says that directors of an entity should consider other disclosures which are not directly prescribed in the guide but are necessary for the financial report to provide a true and fair view. However, the current situation of special purpose financial statements are quite different. AASB research has shown that up to 1,700 entities lodging special purpose financial statements do not comply with the recognition and measurement requirements. This means that two similar companies can prepare a very different set of financial statements which are not comparable, consistent, and transparent. There is also a confusion whether consolidation in equity accounting is recognition measurement requirement or not. Therefore, mandating the ASIC guidance will reduce the risk as everyone will know what exactly is required. As I mentioned, AASB has undertaken some research about the compliance of recognition measurement requirements in special purpose financial statements, and the research has found that 76% of entities lodging special purpose financial statements with ASIC do comply with the recognition measurement requirements in accounting standards. However, up to about 24% of entities do not, or it is not clear whether they do or not. The numbers on the slides that are shown here are prior to Treasury increasing the threshold for large proprietary companies. Kim will take you through the updated figures later on in this presentation. Now, if we look at this next slide, this is talking about the findings or the feedback that the AASB received as a result of issuing ITC 39. Last year in 2018, the AASB issued ITC 39, asking its stakeholders and constituents whether there is a problem with special purpose financial statements. There was a resounding 85% of respondents to the ITC who stated that there is a problem with special purpose financial statements, either because of a lack of comparability and consistency or because it was difficult to enforce the requirements of SAC 1 and other regulations. ITC 39 also asked constituents that if general purpose financial statements was required, what should be the recognition and measurement requirements in that? And again, 75% of respondents stated that the entity should comply with all recognition and measurement requirements in accounting standards. This is not surprising, as I shared with you earlier in a previous slide that about 76% entities who are lodging special purpose financial statements already comply with the recognition measurement requirements. The AASB also conducted a survey with users and others about the requirements, and the feedback was that majority of users indicated that comparability, transparency, and consistency of financial statements are essential. Now, there is another reason why we need to resolve this special purpose financial statements problem, and that is because of the reporting entity clash. What does this mean? As Kim mentioned earlier, there is the reporting entity concept in SAC 1, but that concept actually states which entities are reporting entities or non-reporting entities, thereby it denotes or guides entities as to whether they should prepare special purpose financial statements or whether they have an option to prepare general purpose financial statements or special purpose financial statements. However, the IASB has recently revised its conceptual framework, and it also has a chapter fully on the reporting entity definition. However, its definition talks about the boundary of what needs to be reported rather than who needs to report. Therefore, this means that there are currently two different concepts of reporting entity, and this would surely lead to confusion if the issue is not resolved. Now, on this slide, I'd like to share with you a recent change in the large proprietary thresholds as a result of Treasury making this change on 1 July 2019. The explanatory statement accompanying this revision or increase in thresholds, noted that the new thresholds were set with the expectation to capture entities with economic significance. It also noted that these entities are expected to have users of financial statements. Therefore, it would be now difficult for directors of large proprietary entities to self-assess and say that they are non-reporting entities and that they have no users of their financial statements. I'll now hand over to Kim to take you through the next few slides.
Thanks, Carla. So as mentioned previously, the proposals in this ED apply to entities required by legislation or by their constituting documents to prepare financial statements in accordance with Australian accounting standards or accounting standards. So who exactly does this capture? It captures those for-profit entities required to lodge financial statements with ASIC under the Corporations Act. So your large proprietary companies, your small foreign controlleds, financial services licensees, small proprietary companies with crowdsourced funding, and grandfathered proprietary companies that are required to prepare financial statements, even if they're not required to lodge them. It also captures those entities required by other legislation to prepare financial statements that comply with either accounting standards or Australian accounting standards, so entities such as cooperatives, higher education providers, casino licensees, or some building licensees. And in respect of trusts and other entities required only by their constituting document or other document to prepare financial statements that comply with Australian accounting standards, existing entities whose constituting or other document is amended on or after 1 July 2020, being the effective date of these proposals, would be within scope and would be required to comply with these proposals. This would also include any newly established trusts or other similar entities where the constituting or other document is created on or after 1 July 2020. It's possible there may also be some other entities that elect to apply the revised conceptual framework, and those entities will also be in scope. So which entities are therefore out of scope? As mentioned earlier, not-for-profit entities and public sector entities are out of scope, as entities are entities that are required to prepare financial statements that give a true and fair view without there being any reference to them being required to comply with accounting standards or Australian accounting standards. So this includes gaming venue operators or internet gaming licensees. Friendly societies, superannuation funds and retirement villages are also likely to be out of scope where they're required only to prepare financial information in accordance with Australian accounting standards or accounting standards and are not required to prepare a complete set of financial statements as defined in AASB 101. Associations would also be out of scope where they're required to prepare financial statements that give a true and fair view, but again are not required to prepare a complete set of financial statements. Small proprietary companies that have a requirement to keep financial records by the Corporations Act but have no requirement to prepare financial statements would also be out of scope. And your trust entities and other entities required only by their constituting or other document to prepare financial statements that comply with Australian accounting standards would also be out of scope where that particular document is was created or last amended before 1 July 2020. So what does that mean in terms of affected entities? Based on the research performed, we expect that approximately 7,295 entities will be affected. Of those, we expect there are currently maybe 1,700, as Carla mentioned, that are currently preparing special purpose financial statements that do not comply with the recognition and measurement requirements and will need to step up and amend their accounting policies, with the remaining 5,500 entities being required likely to increase the level of disclosure in order to meet the new requirements of the proposed Tier 2 General Purpose Financial Statements Framework, so the simplified disclosure regime. So we'll now go through our next polling question. Asking whether you think the scope of the proposals is appropriate. The three options, obviously yes, no or unsure. Where you select unsure, we ask that you provide any additional thoughts or feedback that you may have via the survey, which you'll receive at the end of this webinar. Okay, so I can see that almost the majority of the audience have answered. We'll leave the polling question open for just a few more seconds. Okay, so I'll now close the poll. Okay, so as you can see, a majority of respondents today are comfortable with the proposed scope, and we have a number that are also unsure. So as mentioned, if you could please provide your thoughts and feedback regarding why you're unsure via the survey, that would be very, very useful. We've just had a question come through from one of our attendees asking to clarify an entity that has been created prior to 1 July 2020, so for example a trust, whose constituting document requires them to comply with Australian accounting standards, and when they would be captured within the scope. So if the trust was created prior to 1 July 2020 and their constituting document requires it to comply with Australian accounting standards, they would only be required to comply with the proposals in ED 297 if the trust deed or constituting document is amended after the effective date, so if it's amended after 1 July 2020. Okay, so we now have another polling question. So we now have another polling question asking whether you think the exemption for entities with a non-legislative requirement to comply is appropriate. So again, yes, no, unsure, with any additional feedback provided by the survey at the end. Okay, so I can see again the majority of attendees have responded. We'll leave the polling question open for a few more seconds. Okay, I'll now close the polling question. Okay, so as you can see, again, a majority of attendees today agree with the exemption for entities with a non-legislative requirement. We have some that have responded no, and also some unsure. So again, please provide any feedback or observations via the survey at the end of today's webinar. Okay. Okay. Sorry, we're just having a few technical difficulties at our end. Now, before I hand back to Kyla to take you through the transitional relief that's been proposed in ED 297, I just wanted to briefly pause and go over this particular slide, which highlights a number of other projects that we currently have either in progress or in the pipeline. So, for example, the AASB recently issued ED 291, a revised definition for not-for-profit entities, and that project would also link in with the not-for-profit framework project. being undertaken at a future date. In respect of the Public Accountability Project, for example, some other types of entities were identified in the submissions on ITC 39 as potentially being affected by Phase 1, and the board decided that these entities should be considered through the Public Accountability Sub-Project. So this project will consider whether there should be any changes to who is deemed to have public accountability, which is very much an Australian decision, and whether any exemptions from the public accountability definition would be in the public interest. Carla.
Thanks, Kim. So now I'll just take you through some of the transitional relief that the board is proposing to make the transition from special purpose to general purpose less burdensome for entities. So one of the key transitional relief that is proposed in ED 297 is for entities to be relieved from presenting and restating comparative information in the year of transition. So what this means is that for the statement of financial position, you would only show the closing balances for the current year and the adjusted opening balances of the current year. The P&L is even more favorable, as entities would only need to present the current revised general purpose financial statement figures for the current year, and the comparative information for the previous year would remain the same as was disclosed in the special purpose financial statements of the previous year. This is illustrated in the following example. So if you look at this slide, you can see that for the statement of financial position, so if your first financial year end is 30 June 2021, so the current period will be showing the revised or updated figures of the general purpose financial statement for the current year. And for the comparative period, the opening balance on 1 July 2020 will have the updated revised figures based on the general purpose financial statement requirements. If you look at the statement of profit and loss account, the closing balance for the current year, 30 June 2021, will be the updated revised general purpose financial statement figures. However, the comparative for 30 June 2020 need not be restated. It will just be the figures from the previous special purpose financial statements. So this is the relief that the board is proposing, because in most cases, many have said to the board that restating comparatives would be the most difficult area for them. So of course, we appreciate any feedback that you have on this proposed relief. Now, if I take you to the next slide, there is this decision tree that would help entities work out how they can apply the transitional relief. So if we start off from the top, the dark green box, the question an entity would need to ask itself is whether it currently prepares a special set of special purpose financial statements applying full recognition measurement requirements in the standards, including consolidation and equity accounting. If the answer is yes, then it would just continue doing what it's currently doing, and at most it will be merely required to provide additional disclosures. However, if the answer to the question on the top box is no, then it would go, if you look at the left-hand side, then the next question would be whether the entity would like to apply the transitional relief in AASB 1, or whether it'd like to take the route of applying AASB 108. If it takes the route of applying AASB 108, then that would mean that it would have to go back and fully restate all its prior periods unless it meets the impracticable criteria in AASB 108, which is quite a high hurdle to overcome. However, if it decides to go through the route of AASB 1, which is the standard that provides quite a number of relief for entities moving for the first time from special purpose to general purpose. So, for example, it has relief from not restating previous business combination accounting and using deemed cost to measure certain items like property, plant, and equipment. In addition to this, if the entity takes the route of AASB 1, then ED 297 further proposes relief from restating and presenting comparative information in the year of transition, as I talked to you on the previous slide. So on this side, there is a worked example. If you have a group and you have to prepare consolidation, what it would mean if you are taking the AASB 1 route, or if you are taking the AASB 108 route, which means you have to apply AASB 10. I will not go through this slide in detail, but at a high level, you can see that the AASB 1 route is much simpler because you do not need to restate previous business combinations. No comparatives are required. All you have to do is take the carrying amount of the assets on the date of transition and measure them in accordance with the relevant accounting standards, and take the difference between the carrying value of those assets and the investment as deemed goodwill. Whereas if you take the AASB 10 route, then one would have to go and assess each acquisition and determine its fair values from the date of acquisition unless it is impracticable. Now here's another worked example in relation to if you're just looking at a simple property, plant and equipment asset and you're transitioning from special purpose to general purpose and have not applied the recognition measurement requirements. Now what would you need to do? So AASB 1 in this case allows an entity to measure the property, plant and equipment at fair value and use that as deemed cost. If the entity elects this option, then the entity will then treat the fair value of the PP&E on date of transition. For example, let's say it's 1 July 2020 as its deemed cost. However, one important factor that the entity needs to take into account is the tax implication of this deemed cost. So if the asset is revalued to, for example, 11,000 from its carrying value of 9,000, then there is a revaluation reserve of 2,000. However, out of that revaluation, the entity would also need to recognize a deferred tax liability, and let's say that's at 30% of the revaluation gain, that would be 600. So therefore, the double entry on the date of transition would be the land value will be increased by 2,000 and the credit entry will be a deferred tax liability of 600 will be recognized with the balance of 1,400 recognized in retained earnings. So that is the kind of adjustments that one needs to think about on transition. So the next slide just illustrates how the balance sheet would look like in terms once it has been restated when initially transitioning from special purpose to general purpose on 1 July 2020. And now I want to take you through another polling question. So now that I have taken you through some of the implications of the transition and the transitional relief that has that is currently already in AASB 1, coupled with the transition relief proposed in ED 297 not to provide comparatives, do you agree that no further transitional relief is required in addition to what is proposed and what's already there? Or do you not agree, or you're unsure? Please, can you provide your feedback on this? This is a very important question, so I'd encourage more of you to respond to this question. Currently, there are about 68% who have voted on this. Okay. So we've got 70% who have voted, and the feedback is about 74% say that the transitional relief is adequate, 8% are saying no, and 18% are unsure. I will now pass you on to Kim to take you through the timeline of these proposals.
Thanks, Carla. Before we move through the timeline, I just thought I'd quickly cover a couple of questions that have come through via the webinar, so predominantly in relation to scope, so just before we move too much further on. So one of the questions that's been asked is, if an entity does not have a legislative requirement to prepare financial statements, but has a trust deed or a banking agreement or something similar, and they amend that document after 1 July 2020, can it remove the reference to Australian accounting standards to make sure that they remain out of scope? So the answer to that question would be yes. You just need to confirm, obviously, with the bank or whoever was requiring that particular or those particular financial statements, but in principle, yes.
There was also a question from someone about superannuation entities, that if they are not required by the Co-ops Act, but there is a standard AASB 1056 that requires these entities to prepare general purpose financial statements, then would they still have to do that? And the answer is yes, they would still have to do that.
Perfect. Great. So what's next? We released ED 297 in the middle of August, and comments were originally due by the 15th of November. However, the board received some feedback in relation to that particular due date for comments, and the comment due date was extended to the 30th of November. However, this is what we're calling a hard deadline, in that the board has noted that submissions received after that date won't be considered, and this is to ensure that staff have enough time to analyse the comments, reach out to stakeholders, conduct further outreach and summarise the key issues, and turn that around in time for the board's meeting in early March. Now, the aim is to have a final standard issued before the end of June, with the proposed effective date, as mentioned, being annual periods beginning on or after 1 July 2020. Now, early adoption would be permitted and would be encouraged. Now, the reason for this proposed effective date is to align with the increased thresholds for determining what constitutes a large proprietary company. So as Carla mentioned, the revised thresholds are applicable from 1 July 2019, and entities above these thresholds are considered economically significant by Treasury. So it would be difficult for them to continue to determine that the preparation of special purpose financial statements is appropriate given that there are users, they are economically significant, and all of that information was included in the explanatory memorandum accompanying Treasury's decisions to increase the thresholds. The other thing to bear in mind is the additional transitional relief, which Carla just took you through. So this has also been proposed to facilitate an earlier transition to general purpose financial statements. Okay. Now we're coming to the end of today's webinar, so just wanted to, I guess, take a minute to wrap up some of the key takeaways from today's session. So we've talked about it being difficult for directors of large proprietary companies to continue self-assessing that special purpose financial statements are appropriate. But I guess one of the other things that we haven't necessarily spent too much time on is in respect of those Tier 2 entities, and we encourage them to consider the proposals in ED 295 in respect of the simplified disclosures, because this will obviously result in a reduction in disclosures compared with the current RDR framework in many cases, and entities will also have the option not to present a statement of changes in equity under certain circumstances. So there might be some instances where additional disclosures are required by the simplified disclosure framework, which are not currently required by RDR. However, overall, the simplified disclosure regime is expected to be less onerous than RDR. As mentioned, we have a webinar running on ED 295 this afternoon, so feel free to register for that via the website if you haven't already done so. Okay, so if we just answer, go through and answer some of the additional questions that we've received via the Ask a Question function. So there's a question here in relation to transitional relief for trusts. And the question's around, I guess, whether there's any transitional relief provided, because there may be instances where some trusts are inadvertently non-compliant with their constitutional document or the trust deed if they amend the trust deed at some future point. And so the question, I guess, is whether there would be any additional transitional relief or whether that's something that's been considered by the board, particularly for these entities.
Yep. So the answer is there is no additional transitional relief, and that's why there is a lot of education and roundtables held, and also this webinar to create awareness so that those trust entities will and those trustees, these things are communicated early so that they are aware that this change is coming through. The other thing is staff and board have also been communicating with lawyers and the Law Council of Australia and the States to so that they understand the implications of using terms like Australian accounting standards in the trust deeds. So that going forward, when they are using these terms, they understand that it means complying with all the requirements. So again, it is important to communicate to the members, and if they do not want compliance with the Australian accounting standards, then you can always change your trust deed so that such words are removed. There was another question about by someone on what does it mean, how is a small proprietary entity defined? So again, that's not defined in the standards, and according to the COPS Act, there is a threshold for large proprietary entities, and if you do not meet that threshold, but you are a proprietary entity, then you'd automatically be a small proprietary entity. However, as Kim mentioned previously about the entities that are caught in the scope, if you're a foreign-owned small proprietary entity, then you would still be required to comply with the requirements in the standard, because you will be required to lodge with ASIC.
So we've just got some more questions coming through. So the accounting requirements of trusts seem to be a very hot topic on today's webinar. So we've just had a question come through asking a large trading trust, can a large trading trust either amend their trust deed or in the case of a new trust ensure that there is no requirement to comply with Australian accounting standards and therefore still prepare special purpose? Yes, yeah, as we've said, as long as there's no requirement in the trust deed and the trust deed is not created or amended after the proposed effective date of these proposals, they can still continue to prepare special purpose financial statements as they have done in the past.
Yeah, so long as there is no overarching legislative requirements capturing these trusts.
Okay. Just wait another minute or so and see if there's any more questions coming through. Please feel free to raise them if there's anything that you're unsure about or would like additional information on. Okay, so we've now reached the end of today's webinar, and I'd like to thank you for your time and participation today. You have the contact details for both Carla and myself, and as mentioned many times throughout the course of today's webinar, we would very gratefully receive any and all feedback. We appreciate that it's a very busy time of year for some of you, and so therefore you may not have time to provide a formal comment letter. We'd be happy to receive any comments or thoughts you may have via email. We'd be happy to take a phone call or organise a teleconference if you prefer. You can also engage with us via LinkedIn or get in touch with us via standard@aasb.gov.au. So just some useful resources. There are a number of staff papers and research reports available on the AASB website. So as we've moved through the course of this webinar today, for example, both Carla and I have referred to recent research that's been undertaken by the AASB. So those research reports can be found on our website. We also have a hot topics section with guidance and reference material on aptly named hot topics. And you can also view the recordings of these webinars and whatnot via the AASB YouTube channel. In terms of getting involved, we've mentioned that we're happy to receive any and all feedback, but there's a number of other ways to get involved through pronouncements, outreach events, engaging directly with staff, attending any of our webinars or other outreach activities that we undertake. Okay. Now that's the end of today's webinar. There's a couple of questions that have come through the chat function which are quite specific, so I think it might be best to take those offline, but I just wanted to say to those attendees, we have your question, we have your details, and we will certainly come back to you offline. We thank you for your participation. I will be closing the webinar shortly, and in doing so you'll be redirected to complete a short survey and provide feedback about today's webinar. You'll also have the ability to provide any other feedback regarding the proposals. And as mentioned a number of times throughout the webinar, if you answered unsure or no to some of the polling questions, please feel free, or we encourage you to provide your additional thoughts and feedback via this survey, and there is a particular question to gather that feedback. So on that note, thank you, Carla, for your help today.
Thank you, Kim.
Thank you for attending. I will now close the webinar and enjoy the rest of your day.